Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Taking a look again at why IV matters, this time on Sunrun RUN, where some big repeat call buying sets up for some big edge trades, both in a follow the flow with the call buyers out there and also neutral fashion. So let's jump in and take a look. First, here is the scanners. Right here is a couple scanners. Here's the Thinkorswim one that I built. Here is the one also from Market Chameleon. Both of them identified Sunrun, right, as having a big, unusual option activity. Here, as you can see, number 2 on the list, Sunrun, the July 11th expiration, $9 out of the money calls, right, with implied volatility jumping big time, volume over 36,000, right? Also hit up down here on the Market Chameleon one, right? You can see again total volume. This basically takes all of the option volume, more than double, right? The average volume on Sunrun. You can also see that implied volatility rank now at 100%, which means option prices have not been this high over the past year. So this sets up ideally for several implied volatility capture trades. Speaking of IV, here you can see that jump. I pulled off the 30-day IV on Sunrun. A huge jump on that, the highest by far of the year. You can see how much that jumped versus the prior day as well. Just big jump in IV. Also taking a look at it from a different perspective, here you can see the July options, right, seeing the majority of the volume and that over 10% jump in implied volatility in one day. Here it is taking a look at kind of the, smooth 25 delta IV, the at the money IV as well. You can see that it's now trading at by far the highest level over the past month or so, as that big unusual call buying especially drove the IV to extremes. So that's set up for a vol capture trade, looking for that IV at some point to temper the volume to pull back here and have IV drop as well. So here's a covered call idea, right, which is simply going out, buying the stock, selling these expensive calls against that stock position. A very basic, simple trade here. So I pulled off the last time that Sunrun was trading at a similar level versus now. So this is going back to April 28th. Stock was at 750 at that time. The May 7.5 call, the basically at the money call, trading at about 73.5 cents, a delta of 55, right? So the net delta on the covered call, 100 delta on the stock, less the 55, gives you a 45 net delta on this one. And you can see that covered call would have cost about $6.75, right, buying the stock, selling that call against it to reduce the cost. 25 days to expiration. Back is when I pulled it off from April 28th. Fast forward to the day of that big call buying that we saw, right? We can see the stock virtually at the same price, 743. So 7 cents lower, yet the at the money July 7.5 call, right, that has actually 4 days less to expiration, only 21 days. Previously, we looked at a 25-day one, so you'd think this would be less expensive. No, way more expensive by over 40 cents. Why? Because that implied volatility just exploded, basically more than doubled. Exploded by 70 vol points to where it was before, and these were not cheaply priced options before. So that sets up ideally for the covered call trade, right? Buying the stock, selling the call, you could get in for $6.28. Yeah, the stock was 7 cents lower, right? That accounts for some of it, but that call option, right, exploded by over 40 cents. So a lower stock price with a much more expensive call price sets up ideally to follow that flow, that big repeat call buying, and buy the stock, sell these very expensive calls here, getting in much cheaper on the trade. You can see that basically not much change here as far as the net delta, 57. Now, even though the stock dropped, the delta on the option actually increased a little bit due to that jump in implied volatility, pushes that kind of upward drift higher, right? So strangely there as well, the stock dropping in price, but yet the delta on the call increasing just a little bit. So a shorter term trade, 4 days shorter, right? But much cheaper. You could get in for 628, buying the stock 7 cents cheaper, selling that call 40 cents or a little bit more expensive, sets up ideally for that covered call trade. Also taking a look at a strangle trade, right, which is taking advantage of this jump in implied volatility, selling both sides of the market in a somewhat neutral fashion, right? So selling the $7 put and the $9 call, went back again to that April 28th date, selling that $7 put, right, and that $9 call. Could have gotten about 75 cents or so, which would have put you 8 deltas net long, right? The 34 delta on the put, less the 26 delta on the call. So a little bit long, not too much, right? IV at that time, roughly right around 93 and change. Again, 25 days to expiration, going back to the last time Sunrun was here. Fast forward right to the day of the big call buying, right? We can see that the stock, again, virtually at the same price, did drop 7 cents, but that same strangle, right, selling the $7 put and the $9 call exploded to $1.87. Previously was trading at roughly 75 cents, now well over $1 higher, right? And with less days again until expiration, 4 less days. Why? Because this huge jump, as we said, in IV on the trade, basically doubling from under 100 to close to 190. So that absolutely sets up ideally for a sell strangle trade, right, where you are very much rewarded for selling these out of the money calls and puts. And this isn't based on earnings at all, right? Earnings aren't coming until July 30th, roughly, or early August. So this is well before earnings. So this is not a earnings-based trade at all. So doing that strangle trade, certainly a huge benefit, getting more than $1 than you would have the last time the stock was here, but IV was appreciably lower, right? That IV jump that we saw, right, certainly taking advantage of this spike back to the last time when the stock was here and when we were looking in April when IV was down here. So just looking for IV to revert somewhat, which would benefit the trade. Plus, you have much more theta time premium decay as well on that trade, right? When you take a look at the theta on the trade, right, you're looking at 3 and basically the same year 3, so 6 cents a day. Back then you were only looking at roughly a couple pennies a day, right, which each of them showing a theta of roughly a -1, so much more time decay, obviously, because the options are so much more expensive. 4 days less to expiration, so a shorter term trade, which you think would be less expensive as a function of time. Nope. All because of that huge jump in implied volatility and a huge big theta benefit as well for selling them. Same thing with the straddle for those who want to be maybe a touch more aggressive, if you will, that the stock's not going anywhere. So just pulled off the same sort of trade here. You can see the straddle back then trading at $1.48, now at $2.34. So that straddle price increasing by 86 cents, right? So for those who like to have a little bit more net premium, certainly the same idea here, whether you're selling the strangle or the straddle, take advantage of that huge jump in implied volatility that has more than doubled. And then for those who want to have a kind of defined risk trade, the iron condor, which is basically selling a strangle, right, but then buying further out of the money options to define the risk to hedge it. So I looked at the iron condor selling the $7 put and buying the $5 put to hedge it, selling the $8 call and buying the $10 call to hedge it, right? And looked at it back then with the stock at 750 back in late April last time I was here, that iron condor, right, selling in essence the 8-10 call spread, 7-5 put spread. You could have gotten a little bit more than 80 cents. IV just under 100. 25 days to expiration. So your risk on the trade, max risk, $1.16 because you have a 2-point wide spread, less than 83 cents. So a very nice potential return if the stock closed between 7 and 8 come, May 23rd expiration in 25 days. A very nice return, but you can certainly close it out anytime prior. Fast forward to after that big recent call buying again, the stock at 743. We can see that same iron condor, right? The 810 and 75, right? Selling the 810 call spread, 75 put spread, right? Exploded to well over $1.20, $1.25 roughly, right? Why? Because IV absolutely just basically doubled from under 100 to approaching 200 days to expirations. We said again, shorter time frame, which you'd expect the trade to cheapen on that. Nope. So your risk on this trade, right? Same 2-point wide spread, but because you're bringing in $1.26 instead of just 84 cents, right? Your potential risk is lessened dramatically. You're only risking about 74 cents, right, to make $1.26. So your potential return, if it stays between 7 and 8, now 172%, and your break even's obviously pushed out on either side by that difference in price of about 40 cents. So hopefully provide some insight how we go about identifying potential trades here to take advantage of this big repeat call buying out there that just shot implied volatility through the roof. It's not earnings based, right? And basically just looking for IV to soften here, and you have that huge time decay benefit, right? Because the more expensive the options are, right, the more that theta increases or that time decay is in your favor. So you can do a simple buy, right, capture that vol that way, lean with that call buying out there, get into that buy, right, much cheaper, right, than prior when the stock was at roughly the same price. Sell a strangle or straddle, right, or do that iron condor if you want to have defined risk. So until next time, as always, here's the good trading.